Sean Peche of Ranmore has got a special edition for our usual update. Today, we're going to be talking about the surprises that could be in store in 2023 and how well Sean did with his surprise packages for 2022. Well, there we go, Sean. That's a little bit of an intro. I suppose I've let the cat out the bag. You did a year ago give us some ideas on what could happen, the surprises that could happen in 2022. We'll review those in a moment before we look forward to what you suggest could be surprising us in 2023. But why do this? Why actually stick your neck out in this way?
Alec, thanks, Alec. Nice to see you again from a -5 degree UK. It's all started a few years ago, or many years ago. There's a gentleman who worked at Morgan Stanley, Byron Ween, and he used to put out his end of year surprises. And way back when, I used to read them, and it was, he'd been doing it for 30 years, and it was things that just seemed ridiculous at the time, unfathomable. And what was amazing is how often those things would come true. And they weren't forecasts, but it kind of just tells you that you should expect the unexpected, and that everyone, you hear all these macroeconomists that trot out their forecasts and stuff. Well, expect the unexpected. And so last year, when I had an interview lined up with Justin, I thought, well, maybe this will be a bit of fun. Let's do this. I've never done it before. But it does force you to apply your mind and to think about what could possibly be contra to everybody else. And but you can be the judge of that. Some of them are, I've got some right and some wrong. But it's always interesting. And of course, I might double down on some. I'm going to reveal my 23 surprises today. So, but it's really it's not advice. It's just food for thought to think about it. Just so when you hear some charismatic fund manager tell you they know the future, and the economists tell you they know the future, they need to be, take that with a pinch of salt and think outside the box, because more often than not, stuff happens.
Yeah, the unknown unknowns are the ones that knock us sideways, aren't they?
There we go. Absolutely.
So we're going to start today by doing something a little different. We are going to go into the presentation itself. Share this page with you. Let's put that out there.
There we go.
Are you seeing it okay?
I am indeed. Yeah.
Fantastic. Okay. So let's start going through your surprises as you put them together on the 7th of December, 2021.
Yeah. So the first one, Alec, was COVID fades into irrelevance. And if you click again, this was on the Friday, the 3rd of December. It's a headline from CNBC. COVID Omicron had just been detected. It was more contagious. You could imagine the fear that was out there. So we now know, well, COVID has faded into irrelevance. But at the time, it just felt a little bit outlandish. And so that's great news. That was great news. A lot of fear around, and that fear was not warranted. So that was the first one.
I remember that very clearly. I had a trip planned to go to the Eastern Cape, and when Omicron came out, I cancelled it, and I actually lost the money on the airline flight. I don't think in South Africa to get your money back from airlines is not an easy thing, but it was very real, and yet people who've been following COVID said to us, it is going to get weaker and weaker as we go forward. Nick Hudson, Brian Pottinger, they said that's the trend. And so there we go.
And in fact, just on that, I think I'm right in saying that there was a South African doctor or institute or whatever was the first to say this is not a problem. It's mild and don't worry.
It was. I recall the interview that I had with the CEO of Netcare, and he said we've been getting all of these people coming in, and in fact, they have. Not one of them has needed oxygen, was something along those lines. So yes, It did come out of South Africa that Omicron was a lot weaker than the previous versions of COVID-19.
Yeah. So the second one was that Fed raises rates from 0.25% to 1%. Now you can see there the first red circle on the left was where the rates were. This is the Fed funds rate, where the rates were before COVID, and they were 1.75. Okay. And then after COVID, they lowered them to, down to 0.25. And you can see in December last year, there we were sitting at 0.25. Now, what I said at the time was, look, maybe the Fed raises rates just to 1%. It's not even back to where it was. Well, now we at 4%. So, it's amazing how things change. So, I mean, I got the direction right, but I certainly got the quantum wrong.
Well, I suppose from your perspective, being a value investor and with low interest rates helping the growth, it was good to be conservative, but it's actually overshot even the thoughts that you had.
Yeah. Okay. The third one is the tech basket falls 30%. Now, in terms of the index, you'll see there are three squiggly lines here. The blue one is the IT index, and that's where Microsoft and Apple sit. The red one is telecommunications, and that's where communication services, that is where Alphabet and Meta sit because they're communication. And the green one is consumer discretionary, and that's where Tesla and Amazon sit. And you can see that rebased to 100, they've gone down to sort of 76, 72, 66. So not far off, 28% or so, pretty much down, pretty much close to 30%. So that's a bit of a surprise that I think, you could give me a point for.
And how?
Value smashes growth by 30%. You'll recall people were like, oh, do me a favor, value's dead and all the rest. Well, value's beaten growth by about 20%. And actually, if you had your money in the value index, and actually some funds have beaten, value growth by closer to 30%. If you had your money in value, you'd almost protected it, whereas with growth, you'd suffered. So
not almost. It did protect it.
Yeah.
I know that our portfolio was primarily exponential stocks, and that's the growth stocks. And it was only when we started taking your advice and moving away from growth, or at least partly away from growth, that the portfolio stabilized. If you're still sitting in those growth stocks, it's been a really difficult few months.
And Alec, the interesting thing is if you have a psychological challenge now because you're too scared. You don't want to take your losses. Many people don't want to take their losses. They anchor to what it was. Whereas you've got to say, well, hang on, if my cat crawled across the keyboard and sold all those shares tomorrow, would I buy them back tomorrow? That's the way to look at it. Okay. So, right. Small caps beat large caps. I was quite convinced about that. It didn't happen. Large caps have marginally outperformed small caps, this is the world index, which is, quite interesting in that regard. So, because it has been a volatile year, but yeah, so I got that one wrong. Europe beats the US. Now, this is an interesting one because remember, I made this surprise before the Ukrainian war. And so if you'd known that you were going to have a Ukrainian war and natural gas prices were going to spike and all the rest, you would have said, if you'd known that on the 7th of December when I did it last time, you would have said Europe is going to get smashed by the US and Europe is ahead. How about that?
That's amazing. Had you known that there would have been a Ukraine war, surely you wouldn't have made this prediction.
I think you probably, I think so. Absolutely. I wouldn't have made this.
So if there hadn't been a Ukraine invasion, it would have been a very interesting situation. This one.
Well, but what is it? Although I suppose what you do have in Europe is you have lots of tech companies, you have banks and financial companies, and those do well with interest rates and inflation. But the point being that we'll get to that in a minute. If you look at some of the Bank of America surveys, fund managers worldwide are massively bearish on Europe. If I got a pound for every time somebody told me Europe was a basket case, I could probably afford a Fortnum and Mason basket. It's we are massively overweight Europe. Because
you need to interpret that for our South African viewers. If you are based in London and a pound is your currency, a rand's, you wouldn't have been that compelled by getting a rand for every time that you were around. And Fortnum and Mason?
It's a very fancy shop. They supposedly supply the Queen, and so everything comes with the Queen's the royal crest. And it's a fancy shop up in Oxford.
But you live in London and you still think you got a queen.
Sorry. That's me. How embarrassing.
You're focusing on the right stuff.
The Royals. There we go.
The Royals, indeed.
Okay. Bitcoin bites the dust and falls 50%. I was convinced of this one. If it had fallen 50%, that it would have been down to 24,000. Well, where's it now? 18,000. And the news just seems to get worse by the day. So, so I can get a point for that one. I hope you're keeping tabs on all these points, Alec.
Well, you're well in front. You're over 50% by far. Okay. Bitcoin, of course, isn't. But
right.
We'll get on to the future in a moment, which is also interesting, but well done so far.
Yeah.
Inflation?
Number 8, inflation falls. So this was the inflation, US inflation, the blue line, and then you've got the red circle up at the top, which is where inflation was on the 7th of December. And I said it was fall. Well, it carried on going up a little bit. It's kind of where it was back then. So don't get a point for that, I wouldn't say. All right. The dollar falls 10%. Well, that hasn't happened. The dollar's actually risen by 5%. And this is against the euro. So you can see it has pulled back recently. But I think with the rising interest rates in the States, everybody rushed. And with that Fed move that we saw earlier, people moved to the dollar in search of those higher yields. And so, yeah, I got that one wrong. And oil hits 100. So the red circle is where we were. Oil was $70 at the time. The 100 is the red line. You can see when the invasion happened, it was actually creeping up towards 100 even before the invasion. Then it obviously spiked. It has since pulled back to some 77 or so. So I can get a point for that because it did hit 100 at some point and stayed there for a big chunk. But again, I guess the war, the unexpected war, impacted that as well.
I'd give you 2 points for that. I think that was a really good call at the time. And certainly if we look back there, you're in $70 range, maybe just edging up to 75. If you'd had confirmation that it would go to 100, I'm sure you could have made a heck of a lot of money on the way you structured your investments. But let's look at your surprises for 2023, Sean.
Okay, so let's see. I mean,
just tell us before we go into it.
Yes.
How much time do you spend thinking about this? Do you have a little crystal ball around the corner next to your drum set that you look at and work through, or where does it come from?
No, I mean, I we focus on the bottom up. So when I was my inflation, my views on inflation, I was seeing that coming through from what companies were saying in their conference calls way back when. And that's why everybody's going on about this transitory. And I was reading going, hang on, it's not going to be transitory because food companies are saying that they're hedged for a bit. And so they're protected for the first bit. And then those hedges unwind. So this is going to be a rolling. It's going to go from one to the other. And if you think about it, the initial causes of inflation were supply chains with the cost of shipping a container across. It was used cars, it was chips. Well, used cars have collapsed, container prices have gone back to where we are, and inflation is still 7.1%. So you can see how it's handed the baton over to other things. And now what we have is we have wage inflation, and we've got strikes today here in London, or in the UK. And so you can see how it's just moved. Everybody's going, well, there's no ways I'm taking a 2% wage offer. Inflation's running at 10 over here in the UK. Where's my 10%? Otherwise, I'm getting poorer.
But the point being, you read through what's happening in the companies, the commentary from the companies, and then extrapolate that not just from those industries, but across the whole sector, and hence that informs your decisions. Yeah,
for some of them. Yeah, right. Mm-hmm. Okay, so first one. So here we go. Vladimir Putin, this is the other day, says Russia's war in Ukraine could be a long-term process. Okay, so that's what he said the other day. I think there's a good chance Russia retreats from Ukraine in the first quarter. Now, that seems bold, but we know that they're running out of missiles. Everybody's expecting this war to sort of, stop while there's in the depths of winter. We know those Ukrainians are a really smart and have beaten Russia strategically. So maybe they up the ante. Maybe those Patriot missiles arrived from the States. I mean, all the drones got shot out the sky the other day that were directed at Kyiv. So maybe actually Russia retreats. Maybe they lose Crimea. If they lose Crimea, I mean, it's game over. It's pretty much game over anyway. So that would be my first guess, wild guess.
I got to ask you this question, given what you've just said about Russia running out of missiles. Did you follow the story of the Lady R, the Russian ship that docked in Simonstown and was mysteriously offloading and uploading material, which many people here think is South African arms that are going off to help the Russian story?
Goodness, I didn't know anything about that.
Well, if you think about it, if Russia's trying to get arms from South Africa, if that is true, because
Yeah.
the defense ministry, the whole ANC being the ANC, doesn't say anything. But if that's the case, it'll tell you that it does support your story that they might be running out of. They've shot too many of their weapons. Interesting projection, and one that certainly isn't widely agreed at the moment. But that would have implications for the market, surely.
Massive. All right, which brings you to the next one. Okay, almost all, this is from the Bank of America survey the other day, almost all investors expect Europe-wide recession, and the blue chart below is it's the natural gas price here in Europe. It's the Dutch TTF price. So my forecast, there we go, European energy prices collapse, no European recession. Because if Russia retreats and energy prices collapse, boom.
There we go.
No recession. So they kind of linked. But I just think when everybody is expecting a recession, and this is the funny thing about surprises, if everybody is expecting a recession, it's in the price. People have had 8 months to sell European equities. Who've they been selling European equities to? They've been selling European equities to firm hands. People like me, we're not selling them just because they go up 2% tomorrow. Okay. And if the war does end, the war's not going to go up forever. You're going to see fireworks in Europe. So there we go. So no European recession. That would be my call. Right. What you've got here, Alec, is you've got the market caps in dollars on the right-hand axis. The light blue is Apple. So that's at 2.3 trillion. The red one is Amazon. This is just under $1 trillion. And the purple one's Tesla, and that's $500 billion. And my surprise here is mega caps collapse more than 50%. Now, let's take a step back, because people are going to go, at this point, people are going to go, this guy doesn't know what he's talking about, and turn off, okay? If Apple halves and it goes back to $1 trillion, it's only back where it was in 2018. If we have a recession, so that's, it wasn't $1 trillion for all of its life. We have a problem in China with chips. We have manufacturing problems. We have, recession, tough economic conditions. Do you really need to buy the latest iPhone 14? I don't know. So I think there's a good chance that they could miss the numbers. They don't sell as many phones. People don't upgrade as often. And we've seen with PayPal didn't go to losing money. PayPal just surprised a little bit on the downside. The growth wasn't there. And all of a sudden, things correct. So, imagine if we wake up tomorrow and Berkshire Hathaway has offloaded half their Apple. What do you think is going to happen to Apple?
Sure.
Yeah. So there we go. That's Apple. Amazon is still not worth $250 billion. Okay. Amazon, I think, is in real financial trouble. If I was the financial director of Amazon, I'd be selling shares tomorrow and restoring my balance sheet. Because if you go and have a look at their latest 10Q, their commitments and liabilities that they have in terms of warehouses and lease commitments, etc., I think it's over $250 billion, and they don't generate cash flow. And if you think about it, I thought about this as an analogy. We know food delivery is a bad business. Okay. And that is when you don't have warehouses and you don't put food in cardboard boxes. So if food delivery is a bad business, what about Amazon? The answer is going to be, well, what about AWS? Well, AWS, the cloud, it's really using somebody else's computers. But now you're up against Microsoft. Google or Alphabet's making huge progress in cloud, but they're losing money. They're prepared to lose money on it. So they're coming for Amazon. The wonderful business that everybody thought AWS is not going to be the great business going forward. And Jeff Bezos is floating around in his boat somewhere. So I think they're overexpanded in the pandemic, and I think there's going to be bad stuff. And I think that Amazon could easily halve. And I see on the news this morning, Elon Musk's offloaded some more Teslas. So Tesla, this Twitter has distracted him. He's now alienating people. Advertisers are turning away from him, So I think Tesla's got a real chance of collapsing in a heap, and that would still be a $250 billion company, which is way more than any other car company. So when you stand back and you look at it and you go through each of the underlying drivers, I don't think it's beyond possible. And yet these are some of the largest companies held in all the large passives, and actually many of the large fund managers. Many of the most popular funds own these companies. And I think there's a real problem that we see a meta-type collapse in these stocks.
I'm intrigued that you are looking at AWS as a vulnerability for Amazon. Because I guess most people look at Amazon and say, well, AWS will actually cover the current market cap. But you think that there's they're so far ahead of the competition. They were in the game 7 years before the Microsoft and Alphabets decided to go there. But in your opinion, that makes them vulnerable. I guess we got to pay attention.
That's the sweet spot. When the orcas attack the great white sharks, what do they go for? They go for the rich liver. And that's the rich liver, I would argue, of Amazon. And the big guys are going for it. Amazon's moved into Alphabet space on the advertising front. Alphabet's going to take back their cloud. And they've all got the same AI. Don't let anybody convince you, I think, otherwise. And the problem is Amazon can't go and spin it off because the other business, the retail business, needs it. Be bankrupt without it.
Fascinating. Okay, Sean.
Right. So here we've got the value, which is the blue line, and the growth, which is the red line, and that is 5-year chart, both rebased to 100. So my forecast is that value. There we go. Click value beats growth by another 20%. And I think that it's kind of tied to the tech stocks continuing to fall. And so I think that's what's very likely. And you look at it and you go, well, yeah, but hang on, it's already beaten it by 20% this year. Yeah, but that's just value going sideways and growth collapsing. And if growth collapses more, so another 20% is not out the picture, I would argue, especially on a 5-year time horizon. And when you look at the earnings multiples you pay. So that's my fourth surprise. My fifth surprise is what you have here is Europe in the red and the US North America in the blue. And my surprise would be that Europe outperforms North America by 20%. Again, a different one. And I think the other interesting thing is if you start, let's say the war stops and you get some major strategists say, right, let's just take a little bit off the table and move it into Europe. There's not the liquidity to be able to satisfy that. I mean, there's almost not enough lifeboats. If people decide to exit Apple and Amazon and redirect that money towards some European companies, they're not going to get the liquidity. You have to move ahead of the game. You can't be it will move the prices of European equities dramatically. So I think Europe outperforms. This is the topics, the Japanese market in dollars. Okay, now Japanese market hits new highs in dollars. That's my surprise. I mean, how many people are talking about Japanese markets, Alec? Not many.
Not many. Especially you go back here, as you say, you're buying Japanese stocks today at 2017, 2018.
Here we go.
Sure. Yeah,
that's right.
And they didn't have the run that the other stocks did around the world.
Yeah, and I'll tell you what, as we know, it's an amazing nation. I mean, we've just seen that in their behavior at the World Cup. But beyond that, the creativity, they don't have the wage inflation. You have many of the companies are buying back shares now. They've got strong balance sheets. They survived COVID. Japanese companies, we are very overweight Japanese companies in our portfolio. And from a bottom-up basis, I love them. And they don't give away gazillions to share to management. I was doing a calculation the other day, and of the vested restricted stock units in like the 5 large tech companies. In other words, those are share options that people could cash in tomorrow. Okay, and the value at the current market prices, it's like $136 billion for US companies that have the share options that are out there waiting to be sold. You don't have that problem in Japan. So I think Japanese market could hit new highs. Small caps, which is the green line, and large caps are the blue line. I think small caps this year, I'm going to double down. Small caps beat large caps by 20%. And if the Amazon and Apple fall in a heap, well, that'll help that bet. So, I find, okay, so this is an interesting chart. So what you've got here, Alec, are inflation expectations. Now, the green line is the 2023 inflation expectations, bearing in mind inflation is currently running at 7%. And the expectation is that in 2023, US inflation will hit 4.3. And the expectation is that in 2024, okay, inflation will hit 2.5%. That's the blue line. Okay, my bet is that US inflation expectations for 2024 double to 5%. I think what happens is the genie is now out the bottle. And yes, we're going to have some lower oil price, and all the rest is going to feed through and help inflation. But we have things like owner's equivalent rent. It's going to be interesting in the crops, given we had disruption in the fertilizer markets with the Ukrainian war. what the crop output's going to be, and you've got crazy weather phenomenon. Look what's going on here. Look what's happening in all the rains in Cape Town. So that's going to damage some crops. So you could actually see food inflation increase. Who knows? But I just think 2.5% is unrealistic. And I think if inflation goes up, inflation expectations are going to rise and double to 25%.
And again, a big impact on growth stocks.
Correct. Okay. And what we have here is the dollar. So this is the trade weighted currency, DXY, they call it. And I say the dollar falls 10%. Okay. So, that would be my call there. I think that, this is so this last one, Alec, is an interesting one. Okay. This is the assets under management that have moved into ETFs. Now, bearing in mind that when I started this business in 2008, we had less than $1 trillion in ETFs. We now have 10 trillion. And where does the money go? It goes to historic winners. That's what we know, because those become big in the market. And so you can see that the flows in 2015, 16, 17, all the rest has all gone into the Apples and the Amazons and all. Okay. So the money has moved in there, but you now have giants in the ETF market, and you have crypto ETFs, and you have geared ETFs and triple geared and short ETFs, all the rest. Okay. My bet, a large passive manager suffers liquidity problems. Okay. And
what does that mean?
So what that means, for example, what's going to happen with Grayscale now with Bitcoin? It's already selling at a discount. Some of there's been people trying to get out of property funds, but property is illiquid. And so what it means is there's some disruption. There is some disruption with a large passive manager that causes a problem. And I think, it's that old thing in rugby terms, the bigger they are, the harder they fall. And I think they are so big, and there's been so much money that has moved in there based on history, and the world has shifted. We no longer have low interest rates, low inflation, etc. All this money has flowed into stocks that have done well when that environment existed, and they've all been wrong-footed. It's a bit like when the flanker picks up the ball. Everyone's expecting the ball to go down the line to the winger, and the flanker picks up the ball and races around the blind side. People are going to get so everybody who's in these $10 trillion all think that the winger is going to get the ball. So I think a large passive manager suffers a liquidity problem, and that's going to be a problem. So there we go. I'll share some of my views on LinkedIn. Recently, we shared a YouTube YouTube channel, just to some of our content that people like. And it's really the purpose there, really, Alec, is to just educate people. And, we've got some content we're going to do about how to look at balance sheets and how to look at cash flow statements and all the rest. So we're a million miles from the Biz News, but Biz News was our first subscription. So there we go. We've subscribed to the Biz News channel, and I've got some playlists from some historic interviews. So good.
So I brought your pretty face back up here for you to say goodbye to everybody. That's Thank you, Sean. That was really an interesting journey. So what would if you were to make a bet, one single bet on your 10 surprises for 2023, what would your most committed bet be?
My most committed bet is that value is going to smash growth.
So even if Putin doesn't leave Ukraine, even if you don't have the inflation pushing up to the degree that you believe it will, even if you have no shock with an ETF, you still believe that value is going to beat growth. So sell the growth ETFs, buy the value ETFs, and let the rest run.
The problem with the value ETFs, we need another discussion for that, Alec. But the problem with the value ETFs is that companies like Salesforce are sitting in the value ETFs because they've acquired other companies. Yeah. They've acquired other companies. They've got lots of goodwill on the balance sheet, and the value ETFs take into account price to book. They don't take into account price to tangible book. You've got, Berkshire Hathaway has got looks like it's on a low price to book because it's got Apple sitting in its book at market value. But Apple is on a high price to book. So, you've got all these anomalies. So actually, I don't think value ETFs are the way to go. They're very skewed towards the US, and I think there's a problem. I think active value is the way to go. But I know that's talking my book, and people must make up their own minds. But we've had a good year, and, we're up year to date. And so let's see.
Well, Magnus tells me he's now a big Sean Peche supporter, and that's a big thumbs up for you too, Sean. We look forward to getting together again in the new year. Have a wonderful festive season and a good break, and come back refreshed, although you always do look refreshed. Sean Peche is
Thanks so
the
much, Alec.
founder and Chief Investment Officer of Ranmore Fund Management. I'm Alec Hogg from biznews.com.
Thanks, Alec.